So with that, let's go ahead and go into our selection here. This is actually going to be a team effort between Hugh and Ken, since we all wanted the same stocks this session. So go ahead, take it away, guys.
Good. So we both actually picked Walgreen, and rather than, I guess, have two different presentations there, we're going to look at mine. Well, Walgreen actually has been suffering recently, and I think part of the reason the stock price is getting depressed is because of a deal that actually wasn't struck with Express Script, which is an entity. It's a pharmacy benefit manager. So it's kind of got a little bit like a wholesaler. It sits in between companies like Walgreen and often drug manufacturers, etc. It aggregates a lot of health insurance programs together so that it can get lower costs for drugs. And the agreement that Walgreen had in the past with Express Script, I think, accounted for 5 to 8% of the top line of the company. So with this agreement gone, there's concerns that people who have Express Script as their PBM, their pharmacy benefit manager program in their healthcare program, won't be able to go to Walgreens to complete their prescription. But Walgreens felt that the prices that the company was trying to extract weren't acceptable. So I think that's the big driver, Ken. I don't know what your feedback is for the recent price drop.
Yeah, the only thing I would add to that, Hugh, is that the doom and gloom seemed to accelerate even more after Express Scripts mentioned that it was going to try to take over Medco.
That's right, and who knows if that can actually happen. But we'll
exactly.
see.
It's in front of the government right now as an antitrust, and they're trying to investigate it. But the doom and gloom versus Walgreens just got even doomier and gloomier once Express Scripts had the possibility of perhaps growing by another 35% from the size it currently is.
Yeah, it's a real Halloween. You can hear organ music playing in the background with all the doom and gloom around for old Walgreens right now. I took the S off Walgreen in there, I see. And I'm going to look at the stock selection guide and then see what Manifest Investing has to say. And, I optimistically pushed sales growing into the future at about 11%, expenses at 5.5%, taxes pretty hefty there, 36+%. Shares outstanding pulled back a little bit. But the bottom line is the projected earnings per share I got was quite healthy, $4.75, whereas those who like to hang on to the old doom and gloom for the next 5 years are closer to about 4%. The growth that would be implied in the analysis I did would be about 10% a year. And it's currently trading at close to $3 a share. So it's not like it's going to have a dramatic jump. It's not going to double in the next 5 years, but it's a nice anchor for the portfolio. And it actually has a nice dividend yield of, I think, about 2.5 to maybe it's 2.6% today or something like that. So it's not bad at all. And then if we look at part one of the stock selection guide, it's a pretty healthy company going forward. It just ended its fourth quarter in September. The growth rate is flattening out a little bit on the top line, that green line that represents sales from the stock selection guide. But all in all, earnings are up. So pretty sanguine about this company going forward. And we'll see what happens now that the divorce has happened with Express Scripts to see if how or what kind of an impact that really has on the top line for Walgreens going forward. And again, things like the pre-tax profit on sales, it's pretty stable, close to 6%, never topping it, and nice, stable, growing return on equity.
I was particularly impressed, Hugh, with the bounce back in 2011 after the Great Recession. The bounce back to that amazingly consistent margin that they carried from 2002 all the way through 2008.
Like a spring.
Bring that right back there after the recession. So.
Yeah, there were concerns actually, and there was quite evidence quite a significant amount of evidence that some people were actually had discontinued the use of prescription drugs in favor of food, which is kind of a logical thing to do. But you could see it actually in some drugs, especially small drug manufacturers, that their sales dropped. I think of examples like Genzyme, and people were rather surprised by that because they thought these were life-saving drugs. People just had to continue to use them, but in many instances that wasn't the case.
I read an interesting article today in trying to do a little bit of preliminary research on this, Hugh, that indicated that Walgreens and CVS both were going to benefit quite a bit from the loss of patents going forward. Mm-hmm. That the drugstore salespeople actually did better as far as their profit was concerned when they were selling generic drugs, not when they were selling patent drugs.
Yeah, they do better with generics. They seem to be more profitable. I think the days of generics, I mean, generics will always be there, but as an investment, it's been wonderful for the last couple of years. These things tend to be cyclical. There are no signs that the pipeline of major pharma is going to improve dramatically, but it is improving slowly. But I imagine that the days of the glory days of stock appreciation for generic companies is drawing to a close. So here's just a look at part 3 of the SSG, particularly looking at the PE ratio behavior over time. It sank a bit, obviously, during the Great Recession. PEs generally are all depressed right now, but that's just the way things are. And again, we see that it has a nice hefty payout ratio as well. It pays a nice dividend. It's a nice little check to have in a company when it pays a dividend. And if we skip on to part 4, putting it all together, I'm just going to have a time check here. Then
you're doing fine.
I chose a conservative high PE ratio of about 16, and it mirrors what's been happening recently, not really over the last 5 years. The bottom line is that using these figures and using using the estimated low price that comes right out of the SSG and is driven by the current earnings per share number, you get an upside downside ratio, a risk reward analysis ratio of about 4 to 1. Which puts it in the proverbial buy zone. So, I mean, I think 2 minds are better than one, and 2 minds this week certainly wanted to go aggressively for Walgreens. It looks to be in pretty good shape, and that's echoed here on what Manifest Investing has to say, and I think we touched on this earlier. The high quality this company has, the high projected annual return, and then you just run through the numbers. Now, the sales growth is forecast here at only about 8%. I was significantly more aggressive. I am recognizing the fact, I think, that many people are retiring, and as you get older, it turns out that you become a more frequent customer of pharmaceutical products, and as you walk through that store, you might happen to buy some of the other things that they have on offer. But all in all, the signs here are also, I think, very, very positive. Has wonderful financial strength, excellent EPS stability. It's just a gift of a company.
I think that EPS 5-year forecast matches yours.
Yes.
They're pretty close.
Yeah, they are pretty close.
Mark, Marie Bolst.
17 came from on 4BA, the low price, when the trailing 12 months shows 294.
That is because I changed the low PE ratio. I mean, the mathematical average turned out to be 13.3 for the last 3 years, but I kind of emphasized the fact that the PE ratio could be even more depressed in these days of Greece, which gave us civilization, is not taking it back from us. Things like that, you know, PE ratios tend to drop. And so I chose a low PE ratio, which ended up in a low price.
I think she's talking about trailing 12-month earnings, though. I think that's the 217. I'm not sure.
I would have to dig into that and see where that came from.
Because I just looked back to section 3.
Yeah.
And I would expect it to be.
It is 294, yeah.
Something close to that, because that's the most recently completed quarter, right?
I'll go back to the toolkit and see what I did there.
That's just going to give you a huge upside downside. So we'll let you know what that looks like.
Yeah, I'll look at it when somebody else is talking, then come back.
Okay.
Come back to that. And then if we look at what the people of the Motley Fools are saying, you know, especially the All Stars, they're pretty optimistic about this company. And then we finish it off by just looking at a graphical analysis of what's been happening for the last, I think this is about 4 years.
Almost 4 now.
And this is dated September 23rd. So it's right at the end, close to the end of the fiscal year for the company. Stock price has gone down about $3, I think, since then. Be a little more. But all in all, when we just look at this, we're comparing the projected annual return with the quality, we're seeing a bit of a hint here that could be approaching a low in terms of the price. But who knows? It has been a little bit lower, but we're in that zone, as it were.
Yeah, I'll just let you know that my sales growth, I'm a little bit more, I'm a little bit lower than Hugh is.
Mm-hmm.
I'm anticipating sales growth going forward in the 8.5% range. That's still a little tiny bit above where Manifest is, but it's significantly lower than your 11%. But I'm still getting a buy, Hugh.
Good. So what I did here was one of the resources that I think everyone should learn to use as frequently, I'm sure everyone does, are the websites of the respective companies that they're analyzing. And very often they have very nice presentations there and other things that can get the old gray cells churning away. And I just pulled some from the website from Walgreens. This is looking at the drugstore count over time. They're now close to 8,000 stores. They've been increasing steadily since 2001. It's doubled in the last 10 years or so. And that line that goes from the top left over to the right looks on the year-over-year percent growth in stores. So the stores were growing quite rapidly 10 years ago at close to 12%. Now it's close to 8% or thereabouts. And it's measured, I think, when I checked that through by square footage. The employee count is kind of interesting because this is, to me, a very telling graph. You're growing the number of stores, you're growing the amount of square foot, but the year-over-year growth in employees has actually been declining. Now, it's still a positive number, but it's not growing as quickly as it was in the past, which would, to me, hint at increases in productivity for the company. And then if we skip along, here we're just looking at revenues. Year-over-year growth is graphed on the far right axis, and on the left, you're actually looking at the revenue count, which is grown from, it's actually almost tripled in the last 10 years. And then if we skip along to the next one, we can see prescription drug revenue in particular. And the interesting trend here, once again, is that while it's still growing, that line that starting up in the top left and snakes all the way down to close to the bottom right of this chart, shows that the growth is positive. There's a positive percent year-over-year growth in prescription drugs, but that absolute number is declining. So prescription drug growth is declining over time. Not surprising as more and more products become generic. And actually, there is more of a shift towards injectable drugs, monoclonal antibodies, and other products from the biotech industry, which have to be administered in a clinical setting rather than sold over a pharmaceutical counter. And here, again, just profit. Companies' profit is doing nicely. Yet again, the trend shows that the percent year-over-year growth in profit is declining, as to be expected as you go from a medium-sized entity to a much larger animal. I'm not sure if that's the last one. Yeah, net income, same trend. And by the way, you can really see the dramatic impact of the Great Recession. And as Ken pointed out in part 2 of the SSG, it bounced back nicely, and it is bouncing back here. So it'll take another few years to see how aggressively it'll return. Will it return to its usual level? And cash flow, very positive as well. This is cash flow from operations. And the one I like and have come to love as you get older and older, you love the D word, dividends. You can count on them, and reinvesting them can give you an extra bit of oomph for your portfolio. But this is a company that has been returning a lot of the money that it generates to its shareholders. And Walgreens currently has 5 key strategies. It wants really to transform its stores to I don't want to say a Starbucks experience, but it's getting close to that, where people will come to the store for more than just prescription drugs, etc. It is working aggressively to improve its cost, and it's almost like a continuous process to lower costs for the entity. And it's looking to expand across new channels and markets. So it's not just going to be a drug company, grocery sales and things like that, but it will add other higher margin entities to the stores as it sees fit. It wants to become a community pharmacy. I don't know if it's going to push itself in the direction of becoming a pharmacy benefit manager. And it obviously wants to have positive feelings with its customers to make them keep coming back. So for that and other reasons, I think I'm in favor of Walgreen. It's a nice steady grower. It is definitely a behemoth in its space. It's suffering right now for valid reasons, but I'm very fond of saying that I like it when bad things happen to good companies, because good companies have a tendency to recover from even the hardest punch. And let's see what happens with Express Scripts, how that moderates over the next few years. But I think it has a better than average chance of doubling in the next 5 years, or at least getting close to it. So I'm picking Walgreen. I don't know if Ken has anything to add.
We may have lost Ken.
Oh, okay.
Yeah, I think we're ready to move on.
Okay.
Nice job, Hugh.
Thanks, Ken.
All right, we'll log that one in and we'll continue on. Anything
I
else?
just want to comment, Mark. I went back and looked at the SSG that I did for Walgreen, and what I had done apparently earlier, a few months ago, was I had estimated that the price was going to drop. The earnings were going to drop, but they actually didn't. So I'd actually used a lower recent earnings, which were forecasted low earnings. And when I updated the data, it didn't change that.
You're saying it did, right?
No, it did not. It just left it sitting there for some, yeah.
Oh, yeah, you forgot to go in here and fiddle with it.
I forgot to go and change it back, yeah.
Okay.
Yeah, I thought earnings, I can't remember why I thought earnings were going to drop, but I did, but I was wrong.
Well, you've been reading all the gloom and doom out there.
Well, that's true.